In this video, I want to talk about a third option for reducing or eliminating the sequence of return risk in retirement. In this video, you're going to discover the limitations of my artistic abilities, but hopefully you'll be able to understand what we're trying to communicate here. In this particular strategy, what we're looking at is the ability to take our distributions in a particular year or gain flexibility to not have to take our distributions in any particular year from the risk bucket or the equities bucket or the stock bucket, where the sequence of return risks is most acute and the most difficult is that in years where the risk portion of the stock market-based investments goes down, taking systematic distributions out during that time period is the most problematic for the longevity of the portfolio. So in this particular strategy, what we're looking at is looking for an alternative source to take distributions from in the years that the equities bucket or the risk bucket has had a drawdown. The first point we need to keep in mind is that in order for this to work, we need to make our distributions after the fact. Let me explain what I mean by that. If we're systematically taking distributions month after month after month from an actual equities portfolio, stock portfolio, we really don't know whether or not we're in a drawdown, a true drawdown of assets for the year. And so in a circumstance like this, we need to kind of be 1 year removed in order to be able to see what actually occurred during the year in the portfolio. So in this particular strategy, the entire year's income distributions are actually taken before the year begins so that the portfolio itself can actually be monitored to determine whether or not it was an up year or a down year. And so if the portfolio had an up year, then the subsequent year's annual distribution would then be taken from the portfolio. If the portfolio had a down year, it would signal that the coming year's income distributions needs to be taken from an alternative source. So when I have this image up called the equity glide path, let me explain what that means and what these different buckets are. An equities glide path basically is the trajectory of how your investments will deplete themselves all throughout retirement and basically go down to zero over the course of an entire retirement time horizon. This equity glide path is pretty smooth because the assumption is in the equity glide path that you'll just receive the average rate of return year in and year out. That's not what happens, but you can certainly draw a line, a smooth line illustrating just a systematic average rate of return and the depletion of the portfolio over the years as you take systematic distributions out. There will be portions of your retirement where you are above the glide path. You are better than expected. Your returns are more than anticipated, and that's where you'll be in the blue area. There will be times in retirement in years where you will be under the glide path. You'll have multiple months or multiple year time periods where your equities portion draws down, you have losses, and you'll be in the red or below projections. So, in this particular case, on this 1 year behind strategy, in the years that you are above the glide path of the equities portion, you're in the blue, or maybe we should call it being in the black. The coming year's income distributions get taken on a one-time basis from the equities bucket because it can sustain taking that distribution. It's above the glide path. You'll have an alternative, what's called, quote, safe bucket. And once again, we're being a little bit intentionally vague here because there's multiple kinds of assets and multiple kinds of strategies you could use to put money into the safe bucket. In the years that you've had a drawdown, in the years you've had a negative previous, then the coming year's distributions get taken all at once for the entire year from the safe bucket. It may even come from the safe bucket multiple years, up and until the time that the portfolio balance once again gets above the glide path or into the positive or above expected returns. So very basically, to do a summary, instead of systematically taking every single month's distributions out of a volatile portfolio, 1 year behind, you will determine whether or not the portfolio had a positive year and is above the glide path, or a negative year or a negative time and is below the glide path, and you'll determine where your distribution for the coming year's income needs will come from and which bucket will actually be used in order to avoid the sequence of return risk.